In traditional corporate reporting, the company had to talk about their financial performance, but with time, society has realized that just talking about money, talking about the financial performance is not adequate, because there are more other important things that businesses will have to think about. So that is how ESG came about. E is for how they treat the environment. They would normally talk about how they are making use of the resources in our natural environment, so energy use, pollutions and emissions. The S is about how they treat people, talking about the demographics of people they employ, the pay gaps, the composition of the board. And the G is about governance. We'll be talking about how they comply with various legislation in relation to anti-slavery, money laundering, and things like that. When it comes to the ESG reporting, there aren't, unfortunately, any set standards globally. So you have different guidance, and that gives companies a bit more room and choice. That choice there isn't that great, because that then means that the composition of the ESG reports are not comparable, and sometimes what you expect to see is very different from what you actually see. That leads to something called greenwashing. So greenwashing effectively is when the public messaging of companies is a bit different from their actual performance. So they portray a very good outcome and they label themselves as very climate friendly. But when you dig behind the disclosures, you can see there's a mismatch between what they claim to be doing and what they are actually doing. The greenwashing comes in the finance sector, where a finance product that is labeled as an ESG fund effectively has a bit of leeway in terms of what it actually finances. So when you lift the hood, when you take apart the fund, you sometimes realize that even though they are claiming to be an ESG fund, they are financing activities that are causing harm to either the physical environment or are not complying with some of the social legislations.